Hi, this is Tom Kestler. I wanted to share with you a software package that I was recently introduced to called Riskalyze. One of the struggles we've had, although we understand that using an index annuity in a portfolio makes total sense, the struggle has always been, how do you illustrate it? How do you really prove that it makes sense to a client? Riskalyze hopefully gives us the ability to do that. So what you're looking at on the screen is an existing portfolio for a client made up of S&P 500, about 50%, Barclays aggregate bond, 20%, 20-year treasuries, 20%, a little bit of real estate, a little bit of commodities, a total of $800,000 for that client. And what Riskalyze will do is it will rank the portfolio on a risk scale between 1 and 99, obviously 1 being the lowest, 99 being the highest. And it comes up with a factor for this client of 53, shows a probability range of returns from a low of negative 10% to a high of plus 18. And that's the 95% probability over the next 6 months. 95% chance that their returns are going to be somewhere between these two figures. Riskalyze also gives us the ability to run a risk rating on the client. So we can email the client a questionnaire that's very intuitive and comes up with a risk rating for the client. So as we can see here, we've got a little bit of a disconnect. We've got a risk in their portfolio of 53. The client's telling us they're a 40. So risk is a little bit higher than they should be, but not necessarily that much higher. But the challenge then is, okay, I've got 40% of my money in bonds. What's the ongoing risk by keeping the money in bonds, especially in a rising interest rate environment? So we can do some stress testing on this portfolio, and I can take this portfolio and say, what would happen if we just had a 2% or 200 basis point increase in interest rates? What does that do to the portfolio? And it raises the risk to an 81. So you can see how significant that bond exposure is in a rising interest rate environment. And again, see the range of returns or range of potential returns going forward. Then I can take my recommendations and I can say, well, let's keep your S&P exposure, but we're going to take 40% of your assets, or basically your 2 bond positions, and just move those into an uncapped index annuity. We're leaving a little bit of real estate, a little bit of the commodity exposure there, same dollar amount. That portfolio has a risk rating of 50, but when we increase interest rates and stress test it for interest rates, nothing changes. Pretty compelling argument that they're better off using an uncapped index annuity as opposed to the bonds. Then one of the tools that Riskalyze has is a retirement map where I can say, well, let's take a look at that $800,000. I've got a client that wants to retire in 2016 with about $4,000 a month in income. Their existing portfolio has a 0% probability of success. And if I say, well, let's take a look at how that retirement looks like, or looks with my recommendation, I've got a 95% probability of success. Interesting tool, very easy to use. I would recommend, if it's something you'd like to take a little bit closer look at, you just go to www.riskalyze.com. And on their main screen is a tool that will give you a little bit more detailed explanation of how the tool works, and hopefully it will provide some value. If you have questions or you'd like to see a little bit more about our recommendations for what types of index annuities actually work best in these portfolios, please give me a call. The number here is 800-699-0299. Thanks.